Have you ever seen that rupee dollar exchange rate in the news and just wondered, what's the deal? It's not just some random number. Think of it more like a constant, dynamic dance between two of the world's biggest currencies. So come on, let's dive in and figure out the steps to that dance.
First thing to know, this is not a fixed price tag you'd find on a shelf. It's more like a live auction. The price is never ever still. It doesn't just change from day to day, it's literally shifting second by second, reacting to a whole world of news, trades, and what people think is going to happen next. You've probably seen a number just like this one, 83 rupees for $1. This is our snapshot, right? A real number that grounds this whole conversation. But behind this simple equation is a massive global tug of war. And that gets us to the big questions, doesn't it? Who's actually in charge of setting this price? And what are all these invisible forces that are constantly pushing and pulling it all over the place? Well, let's break it all down.
To really get it, we first need to see the stage where this whole performance happens. So welcome to the great currency dance.
This stage is the foreign exchange market. Just picture a giant, invisible, global bazaar that literally never sleeps. Everybody's here. We're talking big banks, giant corporations, investors, even you when you go on vacation. All trading currencies. It is the biggest market in the world by far. And the exchange rate? It's really just the floating price tag in this massive bazaar. It answers a very simple question. Today, right now, how many of my rupees do I have to fork over to get my hands on one single US dollar? So what makes that price tag float up and down? Well, the first and probably the most obvious driver is just buying and selling stuff. Trade across borders. Let's make this super real. Think about all the iPhones being bought in India, all the Netflix subscriptions, all the American goods we use. What is all that buying actually doing to the currency dance? This chart lays it out perfectly. When India imports from the US, millions of us need to sell rupees to buy dollars. That high demand makes the dollar stronger, which means the rupee weakens. But flip it around. When the US buys our IT services or our textiles, Americans need rupees. Suddenly, demand for our currency goes up, and the rupee gets stronger. It's just classic supply and demand.
Okay, but trade is just one dancer on the floor. There are other, less obvious forces at play. These are the invisible movers that can completely change the rhythm of the dance.
Take inflation. If prices here in India start rising faster than they do in the US, our stuff becomes more expensive for Americans, so naturally they buy less of it. That means lower demand for the rupee, and our currency weakens. But if the US has higher inflation, their goods get pricey for us, we buy less, demand for the dollar falls, and the rupee strengthens. Inflation is a quiet but really powerful force. Then you've got the big one, interest rates. So imagine the US central bank raises its rates. Suddenly, American investments like bonds and stocks look way more attractive, offering better returns. What happens? Investors from all over the world rush to buy US assets. But to do that, they first need US dollars. This massive surge in demand for the dollar makes it much, much stronger against other currencies, including our rupee. Money simply flows where it's treated best. So beyond all the hard numbers, there's the whole psychology of the market. A huge part of this game is just about how confident people feel and what they think is going to happen next.
A strong, stable economy is like a magnet for money. When India is showing high GDP growth, our companies are making great profits, and things are politically stable, global investors take notice. They feel confident. They want to invest in India's success. This brings foreign money into the country, which increases demand for the rupee and makes it stronger. See? Confidence is its own form of currency.
This right here nails the power of speculation. The market doesn't just react to what's happening now, it's constantly trying to guess what will happen tomorrow. If a rumor spreads that India's economy is about to boom, investors will start buying rupees today to get ahead of the curve. The expectation of a stronger rupee can, by itself, make the rupee stronger. Now, this whole dance isn't a complete free-for-all. Oh no, there is a very powerful referee on the sidelines who can absolutely step in when things start to get a little too wild. India operates on what's called a managed floating exchange rate. Basically, that means that while supply and demand from the market run the show most of the time, the Reserve Bank of India, the RBI, is always watching. It can and it will intervene, not to set the price, but to stop any chaotic swings that could really hurt the economy. For example, if the rupee starts falling way too fast, the RBI can step in and start selling some of the billions of US dollars it keeps in its reserves.
By increasing the supply of dollars out there, it eases the demand pressure and helps stabilize the rupee's value. It's a pretty powerful tool for managing all that volatility.
Okay, so we've seen all the individual dancers. We've got trade, inflation, interest rates, confidence, and of course, the central bank. Now let's watch them all move together in a single day.
So in the morning, global oil prices spike. That hits India hard since we're a huge importer. We need more dollars to pay for oil, so the rupee weakens. But then, by the afternoon, the U.S. releases some high inflation numbers. The market expects them to react, maybe cut interest rates, so investors start selling dollars. The rupee bounces back a bit. And then in the evening, the RBI issues a statement promising stability, which boosts confidence, and the rupee strengthens even more. You see, it's a constant reactive dance.
So what's the essence of all this? At the end of the day, the exchange rate is fundamentally about supply and demand. And that demand is shaped by a mix of real-world stuff, like trade and interest rates, and also psychological factors, like confidence. And while the market usually leads the dance, central banks can step in to keep the rhythm steady. The price is never fixed. It's always being negotiated, every minute of every day.
So the next time you see that number flash across your screen, you'll know it's not just a number. It's the final score of a complex, global dance. And the real question is, which of these powerful forces do you think is leading the music today?